So in our last video, we talked about trading short straddles. Today's the flip side of that, and it's a long straddle. And just like the short one, it's market neutral. We don't have a bias either way. The difference is we are actually buying a call and a put. But again, we're using the same strike and expiration date. So the goal is we want to see increased volatility of the underlying stock, and we don't care in which direction. So you don't have a directional bias. Now we should also know our line in the sand, and those are the break-even points. And these are going to be easy to identify. Simply the strike price plus the premium for the call, and the strike price minus the premium for the put. And this strategy is best used during periods of low to high volatility. Okay, we want to see that increase. Now, time decay is a factor to consider when you're trading these. Okay, so we want to make money before expiration to be profitable. So how do we trade these? To enter a long straddle, we're going to buy the call and a put at the money option, meaning that the strike price of both options is equal to the current stock price roughly. So for example, if XYZ is trading at around $50 a share, you'd buy a 50 call and a 50 put. You would then hold both options until expiration or until you choose to close your position. Now, your profit or loss is going to be determined by how much the stock price moves and how much time passes. If implied volatility decreases, your position is probably going to lose value because both options are becoming less expensive. If it increases, it'll probably gain value because they're becoming more expensive. And finally, if there's no movement in either direction and time just keeps on ticking by, your position is going to lose value because of time decay, and that's what we don't want to happen. So let's take a real example. And this is BAC stock. It's trading at $36.24 at this time, and that's per share. So to enter a long straddle, we would buy one $36 call for $1.36 per share and one 36 put for $1.06 per share. I'm just using the last prices just so we can keep this fair. So your total investment in this trade would be $2.42. I'm just adding those two together, or $242 for both contracts. So let's pretend at expiration it's still trading at around $36 a share. But because you bought both at the money options, your trade is pretty much break even. If BAC had moved up to $41 a share or down to $31 per share, you would have made money because one option would have offset the loss of the other option. Now, what happens if there's no movement in either direction but time keeps on going? Well, both options are going to lose value because of theta, which is time decay. The amount of time decay, well, it's going to depend on how close to expiration each option is. Longer term contracts, they experience less time decay than the shorter ones because there's more time left on the contract for something to happen. But what is clear is that a drop in volatility on these is not something that we want. Okay, we want that move to be fast, and we want that move to be violent long before the expiration date shows up. Let's talk about break-even profit and loss. Our break-even price to the upside on this example is the strike price of $36 plus what we paid in premium, $1.36, so $37.36. The downside, strike price of $36 minus the premium paid, which was $1.06, is $34.94. Now, when you buy a long straddle, your risk is defined as in our example, and that would be $242. If you think about the short one that we just covered, the short straddle, well, your risk is undefined. So that $242 is the amount that we pay to get into the trade. That's all we're going to lose. The profit potential is unlimited if that stock moves strongly in either direction. On the flip side of that one, the short straddle, our profit potential is limited to what we collected when we sold the put and the call. Here's some tricks for you. So if you think about trends, we often get a strong move, we get a pause, and then we get another strong move. Entering during the pause and that transition back to the strong moves is what we want to do. So when you trade a long straddle, we want pretty much the same thing. We want to enter when we see signs that volatility is about to increase. Okay, we don't want to enter when that large move is underway because we know what's around the corner, and that's the pause. And get out of the trade earlier. So what this means is looking to make a percentage of what it costs to get into the trade. And sometimes the underlying is going to rocket, okay? And you're quickly going to make more than what you'd risk. But oftentimes settling for a more conservative of 50 to 80% of what you risked, that's a safer way to play these kind of trades. It's pretty simple. In summary, it's just a market neutral strategy. and they can be profitable when they're used correctly. So you just buy an equal number of calls and an equal number of puts with the same strike price and the same expiration date. Your goal is to profit from the increased volatility regardless of which direction the underlying security moves. We can enter when implied volatility is low, but is expected to rise, or when it's already high and not expected to decrease anytime soon. That's a bit more riskier. Now, one thing to keep in mind when you trade long straddles is time decay works against you. Okay, it's really important that you monitor your positions closely and take your profits early if you can. We have a download here, 8-Minute Options Cookbook. If you want to learn more about how we approach trading options, totally free. Link is above, link is below in the description. We'll talk to you soon.